Why are people willing to lend money for 10, 20, or 30 years? On the surface, the answer sounds simple. They expect to be paid back. But that is only half the story. A lender is not just trusting a person, a company, or a government to keep a promise. A lender is trusting that the future will be more capable than the present, richer in income, output, and tax revenue, and therefore better able to honor that promise. That expectation sits inside mortgages, corporate bonds, and government debt. A mortgage assumes your future paychecks will keep coming. A corporate bond assumes a business will sell more goods, earn more cash, or at least remain productive enough to cover interest and principal. A government bond assumes the economy behind the state will keep producing enough income that taxes can be collected without breaking the country. Beneath the spreadsheets, the model is straightforward. Lenders are betting that future wages, profits, and tax receipts will be larger than today's. Think about what interest really is. It is not just a fee for borrowing money. It is a claim on future production. When you lend someone $100 and expect 105 back later, you are saying the future will contain enough extra output, enough extra labor, enough extra income to make that $5 possible. In a growing economy, that claim feels normal because more people are working, productivity is improving, and the pool of future income is expected to expand. Long-term lending works more smoothly when borrowers expect rising income. If wages are likely to rise over time, a 30-year mortgage feels manageable. If a company expects future sales to increase, it can borrow to build a factory today because tomorrow's customers are expected to pay for it. If a country expects its national income to grow, it can issue debt and spread costs across future taxpayers who, in theory, will be earning more than current taxpayers. Growth does not eliminate default risk, but rising wages, sales, and tax receipts make fixed debt payments easier to carry. Now imagine the opposite world. Wages are flat, productivity is weak, the population is aging, and businesses do not see much new demand ahead. In that world, debt becomes heavier because the future is no longer arriving with extra capacity. The same mortgage payment bites harder if your income does not grow. The same government debt looks more dangerous if tax revenue stalls. The same corporate loan becomes harder to service if sales stop expanding. Debt did not change, but the future that was supposed to carry it did. Stocks price the same kind of expectation through expected profits instead of fixed repayments. When people buy shares in a company, they are not paying for the company's current quarter alone. They are paying for years of expected future profits. The market takes those future profits and pulls them back into a price today. Valuation is the step where analysts estimate future cash flows and convert them into a present share price. This is why a company can look expensive if you only compare its stock price to its current earnings, yet still make sense to investors. If they believe the company will reach a much larger market, improve its margins, or dominate a category, they are not buying today's business. They are buying a future version of the business. The price reflects confidence that the company will become more profitable than it is now. A stock price therefore reflects estimates about market share, margins, and profits years ahead, not just this quarter's results. Discounting is the term investors use when they convert future money into today's value. Discounting means future money is worth less than money today, because money today can be used now and because the future is uncertain. So investors take expected profits from 5 or 10 years ahead and reduce them into a present value. But before they can do that, they have to believe those future profits will exist. If no one can picture the company earning meaningful cash later, the discounting formula has almost nothing solid to work with. That is why growth stocks can soar in optimistic periods and get crushed when confidence fades. If a company is valued mostly on profits expected far in the future, then any loss of faith in growth hits it hard. Higher interest rates make future profits less valuable in today's terms, and weaker growth expectations make those profits less believable to begin with. First, investors cut their assumptions about sales, margins, or market size, and then the valuation formula produces a lower price. Investors stop seeing a wide-open future and start seeing a narrow one. Venture capital takes this logic and strips away almost everything solid. Many startups lose money for years. Some have barely any revenue at all, Yet investors still give them millions, sometimes billions, because they believe these companies could own a market that barely exists today. A startup building software for autonomous trucking, gene editing, or a new payments network is often being funded on the basis of a future world that is still mostly hypothetical. Venture capital is the part of finance most exposed to bets on a future that has not arrived. The investor is not saying, "This company is strong today." The investor is saying, if technology improves, if customer behavior shifts, if regulation allows it, if capital markets stay open, then this company might become enormous later. Present losses are tolerated because future scale is expected to dwarf them. In venture investing, cash is handed over today for equity in a company whose market, customers, and profits may still be years from taking shape. When that optimism is abundant, startups can raise money easily, stay private longer, and hire aggressively. When that optimism dries up, the mood changes fast. Suddenly, investors want profits now, not stories about market share in 2032. Funding rounds disappear, valuations shrink, and companies that looked promising in a growth-hungry market start looking fragile. The business may not have changed much in a few months. What changed is the market's willingness to believe in a larger tomorrow. Government borrowing follows the same future income logic, but through tax revenue and national output. When a state runs a deficit, it spends more than it collects in taxes and covers the gap by borrowing. That can sound reckless if you picture debt as a static pile, but sovereign debt is usually judged relative to the economy behind it. The key question is not just how much debt exists. The key question is whether future national income will be large enough to carry it. That is the intuition behind debt to GDP. GDP is the total value of goods and services an economy produces. If debt rises but GDP rises faster, the burden can stay manageable or even shrink relative to the size of the economy. If GDP stalls while debt keeps growing, the burden gets heavier. That is why investors usually tolerate more borrowing from a country whose output and tax base are expanding than from one stuck with weak growth. Investors are not only lending to the government, they are lending to the future productive capacity of the society underneath it. Public spending is also easier to sustain when voters and bond buyers expect rising GDP and tax receipts. When people believe the economy will keep expanding, deficits look like something that can be absorbed over time. Roads, research funding, and social programs can be financed with the assumption that a larger future economy will help pay the bill. But when growth weakens, every budget fight gets sharper. The same debt that once looked manageable starts to feel like a direct claim on a future that may not arrive as expected. Finance does more than use forecasts. It writes those forecasts into prices, loan terms, and spending decisions today. A loan lets a household buy the house before decades of wages have arrived. A stock price lets a company raise capital against profits not yet earned. Venture capital lets founders hire engineers for products that may define markets years from now. Government borrowing lets a country spend against future tax revenue before that revenue exists. When that process works, households get homes or education before they have saved the full cash. Companies build factories before retained earnings can cover the cost, and governments spread the bill for long-lived infrastructure across future taxpayers who will use it. Households get access to homes, education, and businesses earlier than their current cash would allow. Companies can build factories, fund research, and expand before internal profits are large enough to pay for everything. Governments can spread the cost of long-lived projects across the generations that will use them. Finance lets income that has not been earned yet support spending and investment decisions made today. But that arrangement depends less on contracts alone than on shared confidence about growth, stability, and future income. It depends on millions of people sharing a broad confidence that output will rise, technology will improve, incomes will grow, and institutions will remain stable enough to connect today's promises to tomorrow's capacity. If that confidence weakens, finance does not disappear, but it becomes tighter, harsher, and more political. Credit gets more selective, valuations compress, governments face harder trade-offs, everyone starts fighting over a future that no longer feels expansive enough for all the claims placed on it. Most people never state that rule directly. but they run into it whenever mortgage payments, stock valuations, startup funding, or pension assumptions depend on bigger incomes later. Housing, stocks, startup funding, public debt, even retirement planning all make more sense in a world where tomorrow is expected to carry more weight than today. Modern finance runs on contracts whose repayment depends on future wages, profits, and tax revenue growing enough to satisfy those claims. Interest rates and valuations are therefore not just abstract figures. They move with how credible future growth looks to lenders and investors.